The Federal Reserve ends its two-day Fed meeting tomorrow, June the 12th, and they're going to be announcing their Fed policy statement. This oftentimes can be a market mover as far as mortgage interest rates are concerned, so we're going to pay attention to it. This meeting has a little bit of extra importance as the Fed is also going to be issuing their statement of economic projections. They only do this every 3 months, and so the markets pay very careful attention to it. The projections give some pretty good insights as to what the members of the Federal Reserve feel is going to happen with the unemployment rate, the inflation rate as measured by the PCE or Personal Consumption Expenditure Report, and of course, they'll also issue their famous dot plot chart, which shows the direction that each voting Fed member thinks the Fed funds rate should go in the future. The markets are expecting no change in the Fed funds rate at this meeting, but according to CME Group, the futures market is pricing in an 89% likelihood that the first cut will be at the November meeting. Even though the Fed won't be cutting rates at tomorrow's meeting, it will be very interesting to see the wording of their monetary policy statement. Currently, the Fed is in a restrictive stance. They're definitely looking for evidence of weaker jobs numbers and or lower inflation numbers before they will change their restrictive policy stance. You'll probably hear the words data dependent multiple times during Fed President Jerome Powell's speech and Q&A tomorrow. If we were playing a drinking game where we all take a drink every time we heard the words data dependent out of Jerome Powell's mouth, we would all be some very intoxicated individuals by the end of his speech. So what would be the catalyst that would change the Fed's restrictive policy to one that would trigger their first rate cut? Well, in my opinion, it will most likely be one of two things. Either core PCE inflation approaching the Fed's target rate of 2%, or a weakening in the unemployment rate. The Bureau of Labor Statistics releases their jobs report every month, and it gives us the unemployment rate. Many market experts think that the unemployment rate would need to hit 4.2% to trigger the next cut. Well, last Friday, the BLS showed that the unemployment rate ticked up from 3.9 to 4% in the month of May. I feel like the latter of the two is probably more likely to happen first, as inflation readings haven't been coming down as fast as we had all hoped for. In my opinion, and many experts' opinions, we're probably going to see the 4.2% unemployment rate before we get close enough to the 2% inflation reading. Buckle up, put on your chin straps, as tomorrow's going to be an explosive and exciting day in the markets and could be a potential market mover for mortgage interest rates as well. Tune in to my next video where I'll break down what happened and the impact of what was said in the policy statement and how it affected mortgage interest rates. Thank you for watching my video, and until next time, let's get better, let's close more deals, and I'll see you in the next video.